joined by Sunil Subramaniam, who is market expert this afternoon. Sunil, IT, this kind of very, very strong move. What's the view there now?
I think a kind of bottom is formed there. And I think the trigger there is two, three things. One is, I think, Jeffries making a big shift in terms of underweight to neutral on the IT sector, including Infosys in its model portfolio. These have been big triggers, and it's not just India specific. Even in the US markets, we see companies like Accenture have kind of recovered dramatically after their very disappointing earnings call a few weeks ago. So I think there is a bit of value buying stepping in here, and some inherent sense of rupee devaluation, because we know that there are a lot strong short-term rupee positives there with the FCNRB and all those stuff. But if you look at the forward premium, they're still showing close to 3% of rupee depreciation 1 year down the road. So IT represents a bit of a hedge against that for FIIs. So there's some value buying. I would still say that the sector is not yet, kind of viewed from a growth perspective. But I think that selective value is emerging, and people feel that the margin of safety has probably increased, that it can't get worse from here. Because parallelly, there's a AI tech sell-off happening across Asia and the NASDAQ. You're seeing that all the huge amount of capex spend that's gone into AI, now people are questioning that is there a return on investments, or everybody's going after the same holy grail? So are there going to be a few failures and a few successes? So some money being taken off the table of the AI piece means that technology-oriented funds probably need to reallocate into the services sector. So you're seeing a culmination of all of that gradually happening. But I would still hold my horses in terms of looking at IT as a growth pick yet. It's still a value pick. And probably from a trader perspective, you can look at the low valuations, you can look at the high dividend yield and say that there will be some amount of pension fund, long-term income seekers buying, coming in and supporting at this level. So I would say with the kind of downside being a bit protected, there are possibly opportunities for tactical players to make some money on the table. So to summarize, I still see IT as a good part of your value part of your portfolio, not yet a big part of the growth part of your portfolio.
Okay, Ambuja Cements came out with numbers. Ashesha here dissecting those.
Well, yes, so largely in line set of numbers, and we haven't seen any major stock reaction either after the company reported its numbers. And let's start with the top line figure, where revenue has come in at 9,500 odd crores, which is a decline of 8% YOY and slight miss as compared to street expectations. But margins have come in line with expectations at about 16.5%. Volumes, meanwhile, have seen a decline, but much like most other cement companies and in line with expectations, this decline has come in line with what we were working with. Remember, one of the major concerns for most of these cement companies is cost spike on the back of West Asia. We have seen fuel prices go up. Power costs have also risen by about 1.7% YOI. Fuel cost is up 4.5% on a year-on-year basis. But the company says that they achieved cost reduction of about 206 rupees per metric ton on a sequential basis. This is led by the cost optimization efforts that the company has undertaken. Other than that, remember, the capacity expansion plans continues to remain intact. The company says that the capacity currently stands at 109 MTPA, and this is expected to rise to 119 by the end of this fiscal. So clearly, they are expected to add 10 metric tons by the end of this year itself. Meanwhile, they said that they've started FY27 on a strong momentum despite the cost headwinds that the company is facing. So no major negative or positive surprises as such, largely in line with what we were working with. Yes, volumes have declined, but this was also expected.
Volume decline expected. Sunil, how are you looking at the numbers from the cement makers?
I see that the larger players are able to hold off. They've achieved cost synergies. They've been able to manage the crude price increase well with certain rationalization. But the small to medium players are probably going to suffer because they are highly operationally leveraged. Also, they are the one sector which will hope for a relatively bad monsoon because monsoon activity, as it picks up, construction activity slows down. So in the near term, that's the one contra to the monsoon. While you have your agriculture and fertilizer and consumption, rural consumption, all praying for a good monsoon, you'll have the cement sector doing the opposite. So how the monsoon plays out also will determine a near-term future for these companies.
That's with regard to cement on charts. Kunal, cement from fundamental standpoint. Kunal, on charts, how is it looking?
Yeah, I think nothing exciting. I think except for maybe Ultratech Cement, which had moved up or showed some signs of recovery few weeks back, or I think a week or back for the stock price when it came back to that 12,000 levels. I think you've hardly seen any major cement stocks showing any kind of a reprieve or any kind of a major up move. Ambuja Cement at current levels of 420 is still almost 15% lower than its 200 moving average. You look at ACC, that stock is also down by more than 15% from its long-term moving averages. So the first level of a breakout which we look out for is 200 DMA. Even that's not been crossed over by these by many of the cement names, and that's why I think the sector is going through its own patch of consolidation.
Okay. Mithali here with a roundup of the Q1 FY27 for the banking heavyweights. How's it looking, Mithali?
Right, so for Q1 FY27, for all these large private banks, if you see the story of resilient earnings that played out in this quarter, while profitability it remained healthy, but talking about their margins as well as the growth, they remained the key trend setters, separating the winners from the others. Talking first about the margins, those remained under pressure for this quarter across the sector, while ICICI Bank was the only exception who could expand their margins on a sequential basis. Talking about the loan growth, it was quite robust and driven by healthy corporate credit growth. But if you see the deposits, the growth, it remained a key area to watch as the loan to deposit ratio, they kept quite elevated. Asset quality, it continued to improve with benign credit costs and also stable stress formation across the board. Return ratios, they remain quite resilient despite the margins pressure that was seen, with ICICI Bank delivering the biggest earnings beat for this quarter. And finally, if you see the funding costs, they seem to be easing gradually, but banks will need further strong deposit mobilization, if you see, for this to support their next leg of growth. So clearly, for Q1 FY27, it was a reinforcement of the strength for these private banks that we have seen. ICICI Bank, it clearly emerged as a standout performer, with HDFC and Kotak delivering a strong and steady execution. While for Axis Bank, it will need that margin recovery to regain earnings momentum, and IndusInd Bank's turnaround profitability as well as improving asset quality, they were quite encouraging. So yeah, good numbers that we saw for Q1 FY27 for all these large private banks.
Thank you so much for that, Mithali. Sunil, let me come to you. Private versus PSU, that's the eternal debate. Where do you sit?
I sit on the private side. Despite the NIM compressions that we are seeing, except for the one bank, which ICICI Bank, the key point here is credit growth is strong, credit quality is good, and I would say that in a period where if credit growth is going to sustain, the NIM should come back, creep back on. Right now, there's a negative reaction because of the NIM compression. So I would say that ultimately, if credit growth is to drive it, then the pricing will take care of the NIMs in the future. So they are doing a good job of actually hiking deposit rates to get in matching capital, that is to the weighted average tenor of the loans. So you see there's also an adverse deposits to CASA balances going, because they're clearly shifting. They're not using just CASA to fund medium-term loans. I see that as a healthy progression in this quarter. The blip in NIMs is actually good because they are taking care of the ALCO, the asset liability composition. And going forward, with the lending creeping up, the price into quantity will play out. The price is of the NIMs, but the quantity, if the credit goes strong enough, absolute EPS should trend up in the next few months. So I would still say, despite the less than expected private banks, earnings and the stock movements, I will still place my near-term call on them. On PSU banks, credit quality continues to be strong, but you can see that sequentially a little bit of compression. So in fact, the market is reflecting that. If you see 1 year, the PSU banks have outperformed the private banks, but get down to 3 months and 6 months, the private banks are slowly gathering the leadership from the PSU banks. I expect this trend to continue. So from a 6 months to 1 year perspective, my call is on private banks as compared to PSU. But you stretch the tenor to a year and a half to 2 years, I would still bet on PSU banks coming back on track with the SME, MSME lending, supporting the capex kind of a growth. They will come back on track. But right now, I would still favor the private lenders.
Okay, we'll slip into a very short break, come back with more, some real buzzers. I want to quickly mark some of those out. Chola Finance, City Union Bank, 7.5% move. Chola Finance down 5, both on the back of numbers. We'll slip into that break, come back, talk more. Joined by Shivangi Sarda of Motilal Oswal. Of course, Sunil still with us, Kunal still with us. Shivangi, how are you looking at the market today? How do you assess the move?
Yes, very good afternoon. So we've seen that volatile cues can be seen today because of the monthly expiry as well. And we're round about, near the psychological levels of 24,000 levels. But once we are, to cross 24,200, then only a fresh leg of rally is to begin. So we're struggling near these levels, but a broader range would be intact for the index. 23,800 is the support that we're looking out for, and the resistance at 24,200 marks. So buy on dip within this range to continue for the index because support-based buying is intact, but upside remains capped as well at the same time.
What's the sense on Suzlon, Shivangi? What's the take there?
Sorry?
Suzlon, Shivangi, the stock is down. Just trying to get a sense as to what you make of that one on charts. Opportunity to buy, or would you avoid at this point?
So Suzlon has given a breakdown, and definitely it would be an avoid for right now because we've seen that the stock has been in a downtrend from the last 5 weeks, making lower top, lower bottom formation. So definitely weakness is persisting over here, and we would definitely wait and watch on this one.
Okay, wait and watch on Suzlon. Do you have a view on this one, Sunil?
No, not stock specific, but generally
But
on energy.
how would you play
itself,
power? Would you play through some of these related plays? Would you play through the EPC kind of play?
Obviously, yes, because the direct power play, it took the overall energy pack itself. I think you have to take the Trump factor into account on oil prices and what happens to that. So it's a highly uncertain period. I know right now we are going through relief because instead of talks with Iran are promising, but Trump, right? Tomorrow he could turn around and say, I've decided to attack them. So I think the whole energy related power, oil and gas, all of these are very, very nervous plays is what I would say. I would rather prefer to wait and watch at this point on this whole pack.
Okay, so that's the take. Let me, in fact, Sunil, I'm curious to know, some of the smaller banks, we spoke about private versus PSU, but some of the smaller banks have really done well this quarter, right? I mean, an AU Small Finance, an IDFC First Bank, maybe not small finance banks, but some of the mid-small ones, Federal Bank.
Yes.
What do you make of some of those? Should that pocket be the ones in which you take the bets?
Yeah, actually, I think so too. Because I'll tell you what's happened is that they have historically been higher cost deposit raisers compared to the larger private sector banks. So on a competitive basis, though the larger banks are trying to hike the deposit rates, and that's why you're seeing the deposit cost going up and the NIMs compressing. For these smaller banks, their costs were anyway high. So they didn't have to really raise them much. So you're seeing the opposite picture there. You're seeing the broad wide that the NIMs are actually improving. And their NPA levels also continue to be stable, stroke declining. So I think that what's happening is that the gap between the deposit rates of the smaller is narrowing. And the smaller guys are able to, because of the franchise element, raise it. And they were always lending to a higher borrowing rate segment, right? Because of the nature of their business model. So that's how their cost versus the advance rates, the NIMs are able to expand. So I think that the smaller banks are probably the ones which are a better bets, I would say, in terms of the immediate future, while the market, senses that the larger banks' NIMs are under pressure and there is a bit of pressure on their prices there. But the smaller banks are definitely beating them in terms of expectations versus performance.
How is it looking like on charts? Shivangi, how is it looking like on charts? Yeah, please.
Yeah. looking at the entire banking space on a whole, we've seen that this index has been underperforming from the last few sessions, and I would actually recommend a little wait and watch over here. We've seen the smaller banking trying to hold up strength, but overall the heavyweights are actually giving up. So overall, banking stocks could take a little bit of a backseat as of now. But of course, we're expecting some range-bound moves here. Momentum is slightly missing, but we'll of course look out for the rollovers as well. Talking about Bank of Baroda specifically, we've seen that this one has been kind of in a downtrend from the last 5 weeks. It has been making lower top, lower bottom formation. So as of now, I think one could actually a little wait and watch over here till the time it kind of bounces back, because it's broken an immediate support zone of 240 levels.
Okay, that's that and some of the actively traded banks and how they've been reacting to their earnings. Just looking at the screen right now, and while we're closing in pretty soft for the day, today the standard performers got to be IT really all the way. And along with that, of course, there's a Radico also, for instance, a bit of a choppy day, and now it's finally spiked up about almost 5% as we speak right now. Eternal, of course, has been a strong one. Kalyan Jewellers, too, it's closing in at the high point of the day. It's a solid 8.25% move that one is seeing. Sunil, just wanted your own anticipation on, how these jewelry retailers need to be moving now. I mean, as we speak, there are names like Titan, which have made a fresh record for themselves. But, it seems like a sectoral move now.
It seems like that because I think gold prices have been choppy, and buying interest starts when gold corrects a bit. So I think that's what is probably driving the sentiment around this pack, because the whole war situation and the dollar strengthening has meant that gold, and including silver, have been a little bit under pressure over the last few months. So that, I think, is actually a favorable tailwind for the jewelers, because if you saw earlier when gold prices were rising, there were a lot of people will just trading in their old jewelry for the new ones. Fresh buying was really limited. But now I think that should change. We are running up into a festival season and a marriage season on the cards. So demand should pick up from that point of view. So I think that sentimental tailwind is what is driving up the whole jewelry pack.
Okay, let's also analyze what is that we can expect from Asian Paints, and a steady quarter it seems is what is anticipated, with revenue, EBITDA and profits all seen growing in the low teens on a year-on-year basis. In fact, Rabinder is here from our research desk to tell us more about what to expect from Asian Paints.
Well, yes, Asian Paint is set to announce its Q1 FY27 earning, and CT is estimating a good set of numbers for the Asian Paint in the quarter gone by, with revenue likely to saw an uptick of approximately 14% on a yearly basis, which was supported with an estimated volume growth of 9 to 10% and driven by the improving demand traction in decorative paints segment and pricing-led growth. And however, EBITDA margin are expected to remain largely flat at 18.1% as higher raw material costs are likely to offset the benefits of the operating leverage, and the quarter is expected to benefit from the price hike implemented between March and June 2026, along with a healthy industry demand, and demand further supported by pre-price hike stocking in April, while momentum remain healthy through the rest of the quarter. And the international business is also expected to report a steady set of number for Q1, and it will be, if we talk about the key monitorable, then management commentary on the possibility for the price hike amid raw material price volatility, demand outlook, gross margin trend, dealer network expansion and market share gains. It will be key watchable.
Okay, that's the anticipation coming in from Asian Paints. Having said that, Sunil, does it seem that a major chunk of the damage for the oil sensitives, your aviation, paint companies, etc., could be well in the price by now?
Well, you'll have to ask Mr. Trump that question. His tweets drive everything. You saw the price went from 72, 78, all the way up to almost 100, back down below 90, all without really much changing. It was just a series of America's intentions around the war, stated intentions and then actions. So I think, it's very hard to say what's the future, honestly speaking. So I would still say that this recent oil, change, because he said now talks are progressing. What's the bet that tomorrow he comes and says the talks have failed? I'm stepping up my action. So I would say, stay cautious around this whole pack right now. let's wait for a little more certainty around the Gulf War, status. Predicting Mr. Trump has always hurt you.
Absolutely.